to the Mortgage Rate Weekly Market Update for the week of September 24th, 2017. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week we saw mortgage rates kind of fall from the lows, moved up slightly. If you take a look at the bond chart on the screen, you can see mortgage bonds hit the high 2 weeks ago, have sold off since then. The short-term trend is for bonds to sell off, but last week they were able to find a floor of support. And on Friday, they were able to rally off the floor of support, but did close right below the 50-day moving average. And then the technicals are all pointing to a possible rally in the bond market. The Treasury technical tradings and the bond market technical tradings looking for the bond and treasuries to rally. So that would be good news. That could move mortgage interest rates lower. So we're looking for the mortgage bonds to rally. We're going to recommend go ahead and floating your mortgage rate to start the week, to see if we can see a rally off the support, move above the 50-day moving average, and move interest rates lower. Now, if we dig into the economic news, last week, big news, Federal Reserve announced on Wednesday it will begin to unwind its massive $4.5 trillion balance sheet starting October 9th, 2017. So that means they've got treasuries and mortgage bonds on their balance sheet. And what they're going to do is every month they get payments and they get loans or treasuries that are paying off. Now what they've been doing is taking that interest and payoffs and reinvesting into bonds and treasuries. So they're not outwardly buying new ones, but they are buying new ones with those reinvestments. And to the tune of $25 billion just in mortgages alone each month. So what they're going to do is start tapering down that reinvestment to let the balance sheet run off. So their proposal is they're going to let $6 billion in treasuries run off the balance sheet and $4 billion in mortgages run off the balance sheet starting October 9th, and they're going to gradually increase that up until they're letting the whole $25 billion of mortgages that are coming back in. They're just not going to buy any new ones, but they're going to gradually taper that up. Now, since they're tapering, there's $1.8 million in mortgage bonds. It's going to take about 7 years with this plan to totally get that off, that $1.8 trillion off the Fed's books. That's what you can see on the chart right there on the screen. All right, so that was the big news last week. Then we saw a weekly initial jobless claims come out on Thursday. They dropped 23,000 claims at 250,009 claims for the week. This was much better than expectation of 303,000 claims. And last week's numbers were actually revised lower from 289 to 282. So jobless claims moving back where they were prior to the hurricanes knocking people out of work. So that's some good news there. And this 259,000 claims was also the sample week that's going to be used in the September jobs report. So we're looking for a good jobs report for September in spite of the hurricanes. Now in housing news, new construction, we saw housing starts for August 2017 were reported at 1.18 million units, which was better than expectations. Now, it was a drop of 1.7% from July, but the drop from July only happened because July's numbers were actually revised higher. If they hadn't been revised higher, we would actually saw a 0.2% uptick in housing starts. And then we also saw that multifamilies were the big reason for the drop. Single-family units were up 13,000 units from July. So overall, the housing market for consumers is doing very good. We saw building permits for August 2017 were actually up 5.7% to 1.3 million units. Now that's an indication of future construction, so that shows that new construction is going to be doing well throughout the end of the year into the new year. Now, then we saw existing home sales for August 2017 reported at 5.35 million units, which was a drop of 1.7% from July. The new existing home sales are down because we've got this very tight inventory. There's plenty of buyers, but not enough homes for sale. It's tough negotiating to get them under contract because there's more buyers than there are sellers. So that we would expect existing home sales to be going down until we fix the inventory problem. But they are still up 0.2% from August of 2016. And with this low inventory, you would expect home prices to go up, and that's what we have. Median existing home price for August 2017 was up 5.6% from August of 2016. That marks the 66 consecutive months of home price gains. So overall, housing still doing very well. We expect home prices to keep going up as long as we have this shortage in inventory. That's going to put a nice upward price pressure on home prices. So what that means is if you're looking to buy sooner rather than later, or you will pay more. In the local news, the next first-time homebuyer seminar is Saturday, October 21st in Newark, Delaware at the Christiana Hilton Hotel. You can register for that event by giving us a call at 302-703 or online 703-0727 or online www.delawarehomebuyerseminar.com. Look forward to seeing you guys next week.